Good day, everyone. Thank you for joining another class for ICAN Online Tutors, ATS2 Financial Accounting class. Today, we are going to be looking at the topic IAS 16, Property, Plant, and Equipment. This is one of the standards that is covered under the financial accounting module of ATS2. So today we'll be looking at accounting standards. We'll look at the requirements and recognitions, how to measure, then all the disclosure requirements. That is what we'll be looking at today. As I've said earlier, regarding all the other standards that we have looked at, IAS 7, IAS 8, I've done IAS 2, I've done IAS 1. So today we'll conclude with the final accounting standard for our level, which is financial accounting for ATS2. So once we are done with this, we are done with all the standards that are required of us. At any point in time, as is usual with our classes, you can ask questions, raise up your hand, or you can unmute your mic. You can send it as a chat, whichever one fits your purpose. Your questions will be answered. So first of all, let's look at what are the characteristics of property, plant, and equipment. It's usually called PPE. I don't know why, but it looks funky and looks easy to call PPE. So when you hear the standard that speaks to PPE, property, plant, and equipment, that is IAS 16. Property, plant, and equipment are tangible items that are held for use in the production or supply of goods and services. This is something you should be able to easily relate with. So we're looking at the characteristics first. So number one is that they are what? They are tangible items. Tangible items. So an example of property, plant, and equipment, number one would be something like your land, land and building, the building on it, it's tangible. And they are used for what? In the production or supply of goods or services. Or you also use it for what? For rentals or for administrative purposes, and are expected to be used for more than one. So naturally, these are part of your non-current assets. Part of your non-current asset that are tangible in nature. This is the standard that speaks to it. So your non-current assets that are tangible in nature. You know, when you speak about non-current assets, when we looked at IAS 1, preparation of financial statements, we looked at current asset, non-current asset, and we said non-current assets are the assets that are what? That are used for more than 1 year. They have a lifespan of more than 1 year. Examples of this is land and building, your motor vehicle, your machineries, and so on and so forth. So you can see the characteristics are now, let's just look at them one by one. They are non-current assets. They have useful life of more than 1 year. They are used in the production of goods and services or for rental. The benefits from its use, flow to the organization. If you use property, plant, and equipment, even if it is just for administrative purposes where your head office is, the benefits of the work that they are doing in that head office flows to the organization. They might not be the one, might not be a factory space, but whatever they are doing in that head office, whatever benefits that is being derived from having your head office in that building, either by benefits is by publicity or is by the work that they do in that building, it flows to the organization. Number 5 is that the entity has control over the use of the asset, has control over the use of the asset. Now, let's look at what is the recognition criteria How do we recognize that this is what? Property, plant, and equipment. There are two criteria to be used. Two criteria are to be used to determine how we can recognize property, plant, and equipment. Number one is that it is probable that the future economic benefit associated with the item will flow to the entity. Once there is a future economic benefit to be derived from the use of the asset, then that it is probable that there's a future economic benefit to be derived from the asset. Number two is that the cost of the item can be reliably measured. The cost of the item can be measured reliably, And one, if the value of an item is insignificant individually, an entity can aggregate the value of such similar items so that they can be material and qualify for recognition. So that they can qualify. You can say, I cannot recognize maybe something that you use for a long time, probably because the amount is too small. What you can do is you can put all similar items that look like the same of those type of assets, put them together. When you put them together, you can sum it up so that they can now qualify for recognition. So you can see an example they gave us is molds and dies. The die itself and the molds, you can put them together. To put them together, they are similar. You can't use the mold without the die. So you have to put them together. But the die itself might be maybe in value, might be very small. But by the time you put all of them together, the asset might be very huge and material. So, however, each unit of the items must be expensed if they cannot be aggregated with similar items. If you now see that this particular item, though it will take me for more than 1 year to use, but I can't pack it with similar items. Do you understand? Just expense it off because they are what? Immaterial. You can't start doing depreciation on it, and what you are calculating is 10 kobo for every depreciation. Do you understand? They are immaterial. All you just need is expense of those kind of assets. But if you can aggregate them, and the aggregate will give you an huge amount, then aggregate them with similar items, then you can value them as
I don't understand.
You don't understand? Okay.
Yeah.
So I'm trying to think of an example that I can use. Because example will really bring it home a lot. So let's say, for example, I'm just going to use this example. It won't really classify as a non-current asset. It should really go as an expenses. So let's say, for example, the company you work with, let's say you guys hardly use maybe a laptop. I'm using this one from my head right now, right? But laptop cost is a bit high. So you should even be able to. I'm looking for an example. Give me an asset that is not that expensive that you use for more than 1 year.
Phone.
Can you think of one?
Okay,
Can you hear me?
Yes, sir.
Hold
I
on.
hear
What's
you,
going
sir.
on? What is it?
I said phone.
Phone.
Yeah.
Okay, hold on, please. Okay. So phone. Okay, so let's use phone. So let's say the office bought maybe a few phones for some people, right?
Mm.
It's office phone, but it's not like the desktop phone. Maybe they bought phone, but it's office phone. but it's not that much, right? You can look for similar items within that bracket. Let's say for example, we bought office phone. Let's say we bought something else that is small, of maybe a digital device too, that is maybe small. Let's say memory card, right?
Yes,
Or hard drive. Office phone, hard drive. We bought some small items that we could really have used for more than 1 year. If you know, in the first situation, we bought everybody in the office phone, right? In the first situation, office phone and what? Hard drive for every system. If we take only one phone, the cost will be too small for us to be saying we are taking one phone. Do you understand? And we are aggregating it. Do you understand? It will be too small for a big business. Let's say for a bank like First Bank, they bought one person one phone. They now said they want to be depreciating that phone for 2 years. Do you understand? So what they can do
yes,
is aggregate all the phones or something, all the phones, all the hard drives. You can just say digital equipment, right? And aggregate
yes,
all of them together. Are you getting the point now? So when they aggregate all of them together, the amount now will be very high, will be very huge, right?
yes, sir.
So when the amount is now huge, they can now put this on their balance sheet, right? And now be depreciating this kind of assets. But if the value is so insignificant that it is very small, do you understand? What they need to do is
Yes,
just expense it off from their income statement. They don't need to carry it as an asset on their books. Do you understand now?
yes, sir.
Okay. So another part is that the major amount of major overhaul or inspection government of an asset can be recognized as an item of PPE if the original cost can be separately identified and separately depreciated. The original cost can be separately identified and depreciated. So let's look at the measurement and recognition, of PPE. How do we do the initial measurement, and how do we treat um, um, this? So let's look at this. Initial measurement of PPE is what should be recognized at initial cost. Should be recognized at initial cost. That is how to do the initial measurement. We'll look at subsequent measurements. You can see here, we'll look at measurement after we have recognized it. But this is the initial measurement. The initial measurement should be what? Should be recognized at initial cost. So you now say, how do I recognize initial cost? What are the elements of the initial cost that I should factor into my initial recognition? So the things that form part of your initial cost are the purchase price that you paid. Purchase price. This is the amount that you paid. And it should what? It's including import duties. Let's say you bought it from China. You paid import duties in Nigeria. That import duty is part of your purchase price. And any other non-refundable purchase taxes, less trade discounts and rebates granted by the supplier. So you can't say, the cost of this thing is 1,000 naira. 1,000 naira. That is how much you bought it from China. You paid tax of, maybe when it got to Nigeria, 100 naira. All the taxes and import duty, 100 naira. Meanwhile, the guy in China gave you discount of 70 naira. You have to remove it. You didn't pay for it. Do you understand? So all this one, you now say, 111 plus minus 30, minus 70, then you'll have 1,030 naira. This is your now what you will recognize. I hope you understand this. Then number 2, elements of cost. Costs that are directly, this word is very powerful in this case. directly attributable to bringing the asset to the location, not only to the location, but to the condition for its intended use. So after you paid this one, this is the cost that you bought the asset. Let's say it's a machinery. This is, you bought the asset. This is the import duty. This is the discount that you got. This is the cost that it took to get to your location, to Nigeria. But you needed to pay for what? Transportation to take it from the port home. You needed to maybe build another, let's say it's a generator. You needed to build a house. You need to prepare the site, build a house for the generator. There's somebody that is coming to install it and maybe assemble all these things together. Anything that is directly attributable to bringing the asset to the location and to put it into a condition that you can now use it. Because in the first condition here, you can't use it like that. If it is at the port, you cannot use it. If you bring it to the location, oh, okay, I've added cost of transportation, you drop it at your location, but you can still not use it. Anything that brings it to the location and to the condition that it is now perfect for use, all these costs are what we call directly attributable cost. You must add it to what? To any amount that you got. So let's say this 1,030 naira, we write 1,030 naira. This 1,030 naira. We are going to still add what? Transport cost. Let's say transport cost is 100 naira. We're going to add transport cost. If we pay, we build one house for it to make it come. Let's say that one is 15 naira. Or we prepare the site, or we just cleared something just to say, this is the position it will be. We prepare the site where it's going to be. We are going to add the cost. The people that is going to install it, they say they are coming from China too to come and install it. Otherwise, nobody can install it in Nigeria. Let's say we pay 200 naira for that one. Then the people that said they are going to install it, their workmanship, maybe they collected 10 naira, the employees, they collected 10 naira. Oh, you now went to the bank. It was from the bank that you borrowed money to go and to buy the asset, maybe this 1,000 or maybe all this stuff. And the bank is going to charge you interest. All this borrowing cost is going to be capitalized. The cost that you pay on it, let's say it's going to be 5 naira. You are going to charge it on it. All these costs, you sum it together, and that is what we form what? Our initial cost. Our initial cost. It should be what? Recognized as initial cost. Let's continue. Costs that are not directly attributable, like advertising costs, promotion costs, training costs, should be expensed in the period they are incurred. These things are not directly attributable to bringing the asset to the location and into what? To the condition for use. The same principle for measuring cost apply to both acquired and what? Constructed assets. The same principle. So assets, you can say you are the one that is going to build it yourself, right? You can say you want to construct a similar item. Whatever cost that you incur in bringing that asset to a state of use, of its intended use, and to that location will be added to be part of your cost. Let's look at measuring cost. Measuring cost. Sorry, do you have a question for me?
Say the last one. Can you come again? I don't understand. I don't really understand.
I can't hear you. I can't hear you very well.
I said the last one. Can you hear me now?
Okay, the last one. You want me to explain on the last one? Hold on, let me go back to the previous page. Okay, on this one, right? This last point
Yes.
D.
Yes.
Is that correct?
Yes, sir.
I don't know what's wrong. Your
Yes,
mic
sir.
is a bit muffled up.
Maybe because I'm using my phone.
No. It's just not loud enough. Okay.
Okay.
So this same principle that we applied here, right? You know, we said elements of cost. What we are going to add is what? The purchase price. We'll add all the import duties and all the costs that are directly attributable to bringing the cost, to bringing the assets to the location and to our desired condition of use, right? We now said that this same principle of measuring cost apply to both acquired assets, means assets that you are buying, right? You know, the example I used there, I said we are bringing it from China, purchase price. You remember, this one is what?
Yes.
Import duty. This one was the discounts that we got. Then I started putting cost of transportation. Do you understand? This was an
Yes.
acquired asset. We bought the asset from China. Now, we're now saying that this same principle that we applied here also applies to assets that you decide to construct yourself. So asset that you decide to construct yourself, let's give an example. Let's say you decided to construct a house or your office. Let's say you decided to construct your office. You did not buy the office. You decided to construct your office, right? So one of the purchase things that you will buy will really be what? Let's say land, right? You buy the land.
Yes.
The price, let's say, is 1,000. 1,000. You will buy, after you buy the land, you will pay for maybe all these Lagos State tenancy and the likes, all those taxes on the land, all those registration, anything that you do to bring the land up to the point of use, right, will be added as cost. Let me just be listing them. I don't know if you have built house before, but let's just be listing them. You buy, you pay for taxes, you pay for professional person that was going to work on the site, right? You buy block,
Yes.
all the things that you buy, all those ones will be part of purchases, all the things that you purchased, right?
Yes, sir.
Land, you purchased it, land, all the professional fees that you paid, all the people that will work at the site, the electrician, the bricklayer, the engineers, the electrical engineers, all this money that you pay them for their professional fees is part of what, because if you don't do it, the building will not come to its intended use. Are you getting the point now? Or do you still want me to take it again? So
I
anything you
understand.
pay, either the same way we apply this concept here, anything you pay for, it applies to assets that you acquire and assets apply to assets that you construct. Just look at it this way. Any money I pay to bring an asset to the desired or intended condition before I can use it, it is what? It is to be classified as part of the initial cost. Do you get it now?
Yes, sir.
What do you say?
Yes, sir.
Okay, thank you.
Yes, sir.
So measuring of cost, we're still under measurements and recognition of cost. So the cost of an asset is measured at cash price at the date of acquisition. If payment for an item of property, plant, this is plant, not planning, and equipment is deferred beyond normal credit terms, e.g. finance, lease, and hire purchase, the difference between the cash price and the total price is recognized as a finance cost. So for example, let me explain this part. You went into an hire purchase agreement. Cost of the asset is 10 million. Let's say 10,000. Okay, is 10,000. This is the cost of the asset. They now said that if you want to pay us you can do us and do it in breakdown of paying small, right? Paying small. Cost of the asset as at the date of purchase is 10,000. But you can pay us small. Pay us 4 million every year for 3 years. So your payment is now 4 million, right? So 4 times 3, you pay 4 million every year, and you pay it in 3 years, right?
Yes, sir.
4 times 3 is what?
12.
12. This is 12. So what this means is that the cost at the date of purchase is still 10,000. This part here is how you desire to break it down. So the difference between this amount and this amount will be a finance cost. Will be what? A finance cost. And this one will be expense. If an asset is acquired in exchange for another asset rather, not asset. If an asset is acquired in exchange for another asset, the asset acquired is measured at its what? At its fair value. The asset acquired is measured at its own fair value. And if the value of the asset acquired cannot be determined, the item is measured at the carrying amount of the asset given up. Is measured at the carrying amount of the asset given up. I'm sure you understand what it means to measure something at fair value. Measure something at fair value means that the market price as at that day, the market price for that asset as at that day. You exchange your old phone for another new phone. What is the value of that new phone as at that date? That is how much. But if it is now possible that you cannot estimate what the value of the new phone at that particular date is, or it cannot be measured, then you identify the cost as the carrying amount. This carrying amount means that the amount on book, this is the cost minus depreciation. So carrying amount means that this is our initial cost. Then we have depreciated the asset over time. Our net book value is our carrying amount. So you remove the value of what? You remove depreciation. So initial cost, less depreciation. This one will give us our net book value, and that is the carrying amount. So this is accumulated depreciation. Accumulated depreciation means that what you have been depreciating, the summation of all your depreciation over the life of that particular asset. Hope this is clear. Can I move to the next slide? I want us to finish the theory part, then we can now start solving examples. What do you say?
Please, can you explain again?
Okay. Regarding this last part, right?
Yes,
the
sir.
fair value and the carrying amount.
Yes.
Okay. So fair value means the amount that you can get that asset in the market as at that particular day that you bought it, right? When you see fair value, it means amount that it is fair. Let's read that one. What's the fair amount to pay, right? It will imply that what is the amount that this thing is worth in the market. Do you understand now? That's fair value.
Yes.
Now, when I'm saying that, if it is now possible that it's possible that the asset that you exchanged, it's possible that you cannot get the market value of that asset or how much that asset is worth in the market, right? It is possible that you are not able to value the amount is worth in the market. What you will now do is that you will measure that item that you just bought at the carrying amount of the old assets. How much is the old asset in our book, not how much is worth in the market though. The asset I gave out, I bought it at a particular cost initially. Let's say I bought the asset at let's just use the same one. I bought it at 10,000 or 10 million. I have used the asset for, let's say I was planning to use the asset for 5 years. I've used the asset for 4 years. That means I have used like 8,000 out of this 10,000. So it's only 2,000 that is remaining. That is the carrying amount. So carrying amount is initial cost. We are still going to do this in detail, so don't be in a hurry. Initial cost less accumulated depreciation. This AD is accumulated depreciation. And this one will give us what we call our net book value, which is the same thing as what? Carrying amount at the end of the year. You remember when we did our accounting and we're doing balance brought down and balance carrying down? That's carry, that's where you pick it from. Carry down, that's it. The balance you carry down, that's the carrying amount. So the asset when we bought it was 10,000, right?
Yes.
We want to depreciate the asset by 2,000 for every year. We have used the assets for 6 years. That means we have depreciated. We have taken an accumulated depreciation for 2 million for 3 years. 2 million times 3 years will be what? 6 million. So we have taken 6 million, right? So carrying amount on this asset is no longer 10 million. Though we bought it at 10 million, our carrying amount is what? 4 million. We are now saying that in this situation where you cannot measure it, this asset that we want today, let's say the asset is actually phone. Let's just use this as the phone. So the carrying amount for this phone is what? 4,000. But the one that we just got, we are unable to value it at its fair value. Do you understand? What we will do is that we will measure the new phone that we just got and we will maintain this net book value, this carrying amount, as the value of the new phone. Do you understand now?
Yes.
Do you understand now?
Yes, sir. Yes, sir.
Okay, thank you.
Yes,
Thank
sir.
you. Okay, thank you, Motunrayo. Let's go to the next slide. So measurement and recognition. We'll quickly do this example. Sky, just to gauge our knowledge for this. So Sky Power PLC purchased a Sky-oriented machine to be used for a project. And this is the cost here. This is the cost on your left, on your right-hand side. This is the cost here. So they gave us additional information here. This test run was to ensure that the asset was installed, working correctly without causing any sky pollution, right? If you look at this information that you have on your screen, can you tell me the cost that will be involved? Which items are we going to use as cost? And which one are we not going to use?
Purchase price of the machine.
What do you say?
I said purchase price of the machine.
Okay, purchase price of the machine. Okay.
Cost.
Speak up, let me hear you.
Delivery cost.
Delivery cost will be part of it. Okay.
Then installation cost.
Installation cost. Okay.
Trade discount given.
Trade discount given. Are we going to add that or to the cost, or we are going to use it to reduce the cost?
We're going to reduce it.
We are going to use it to reduce the cost. Thank you. Continue.
Then cost of site preparation.
Yes. Are we going to add that or use it to reduce the cost?
We're going to add it.
We are going to add it. Yes. Continue.
Then architect fee.
Architect fee. Yes. So that's like the professional fees that you have to pay. Okay. Yes, that's part of it. Continue.
I think that is all for the.
What do you say?
I think that is all for the cost.
That's all for the
The
cost. What about administrative
yeah,
expenses?
that is all for the initial cost.
What
The
do you say?
administrative, I said that is. I think that is all for the initial cost. The administrative expenses is not part of it.
Okay. What about test run cost?
Test run cost. Test run is not part of it. So I don't really understand this test run cost.
You know, if you buy a new asset, after you
Yes.
did all the installation, they are going to test run it to
Okay.
see if it is working properly. You know what test run means now?
Yes, yes. When you want to test something,
Exactly. So do you think it should be part of it based on our definition?
no,
Let's go back to our definition.
it will be part of it
Okay. So why should it be part of it?
because it's just like um, it's like part of the purchase.
The condition, don't forget what we are using. The condition is what? Location, that brings it
Installation.
to its location, and condition
Location.
for its intended use. Condition for its intended use. If you don't do the test, how will you know if it's in the right condition to be used? Do you understand?
Yes.
And when they finish installation, you will say, okay, yeah, Oga, go. Don't need to don't need to test it, right? You won't know if it
Yes,
is
sir.
in the right condition for its use. So whenever you are doubting something, just look at the amount and say, would this amount be part of the cost that should be included for its intended use? If yes, then do what? You add it to the cost. You add it to the cost. So that's that. Let's move on. So measurement and recognition. After the initial measurement, after recognition rather, after the initial recognition, measurement, we are still on measurement and recognition. That's what we have been working on since. Measurement and recognition. We've looked at the initial measurement. We said what? It should be measured at cost. And we have looked at all the elements of cost. And we have said, oh, even at the initial cost, it should be measured at the date that you have acquired it. And if you are using it to exchange an asset, you are using it to exchange an asset, measure it at the fair value of the new asset, or if you cannot measure the value of the new asset, measure it at the value, at the carrying amount of the existing asset that you have given up. Now, we're not saying that it's also possible to measure assets even after you have made that initial recognition. And that is what we are going to look at now. So after recognition of each initial item of property, plant, and equipment, measure should be measured using their cost model or the valuation model. So you can either use the cost model. You can't see my screen?
Yes.
Why did it stop sharing? Oh, thank you for raising that. Okay, Iban now.
Yes, I can see.
Okay, so let me take that part again. So measurement after recognition. The first part that we looked at, we said it should be measured at cost, and that was the first part. Now, you could measure property, plant, and equipment after their initial recognition using either the cost model or the valuation model. So we're going to look at the two. Any model you select must be applied consistently. So you cannot say, yesterday I'm using cost model, today I'm using revaluation model, then you go back to cost model because you see that one favors you. You know that one of the principles of accounting is that what? Anything that you use, you must be consistent with it. And whenever you are changing, you must what? You must add it as notes to your account. Give reasons why you are changing. Remember when we looked at IAS 8? So using the cost model requires an asset after initial recognition to be carried at what? Cost, less accumulated depreciation and impairment losses. You remember when I was trying to make an example from this, when I was explaining at this stage, when I said initial cost, right, of 10,000, you remove accumulated depreciation. You remember this, and I said you pick it at net book value. That's the same thing that we are looking at here. That's the same example that clarifies this. So on using cost model, you pick what? At cost, less accumulated depreciation and impairment losses. You might ask yourself, what is depreciation that this man is talking about since? I'm sure you are aware, but just in case you are not aware, depreciation is what we call as a systematic allocation of a depreciable amount of an asset over its useful life. An entity is required to apply depreciation to an item of PPE on systematic basis over its expected useful life. You remember when we were looking at IAS 7 in our last class, and I was mentioning add back depreciation. I gave a little bit of context into this. It's a non-cash item. So in accounting, you buy a house worth 10 million naira, or you buy a car worth 10 million naira. You don't say, Shebi, I've bought the car, 10 million naira is my money, right? You look at, oh, how long will this car serve me for? Oh, it's going to serve me for 5 years. What depreciation method do I want to use? Straight line or reducing balance method? If it is straight line, then I apply equal amounts over the useful life of the asset, right? Then once I do that, I will say, oh, 2 million naira per year. So I will not just expense the 10 million naira that I spent and expense it in 1 year. Because I didn't spend that 10 million naira, the asset is not valued for only that particular year that I bought it. It's useful for me over a long time. So why not just break down the cost of the asset over and apply it as expenses over that period? While you are removing it, you will now retain it as a non-cash item in your balance sheet. You understand? So there's the cost part, the amount that I spent before. Then you now be removing that amount small, gradually over. So you usually see that it's a systematic allocation. What is the depreciable value? The depreciable value is the cost of the asset less its residual value. Depreciable value is what? Cost of the item less residual value. So you bought an asset for 4 million. 4 million. That's the cost of the asset. For example, the car that I was using, you bought the car at 4 million naira. The residual value is the money that when the car, you can't finish using the car fully. You now say, the car will be worth 500 naira in year 4 when it's no longer useful for me as scrap value. So this is the depreciable value. That means this is the residual value. That means that the depreciable value is what? 4 million minus 3 million, which is what? 3,500. That is the depreciable value. So this is the value that you will depreciate over that 4 years or 5-year period that you want to use the car. Because at the end of the 5th year or the 4th year or the final year of using the car will still be worth 500,000 naira. So you pick 500,000 naira and sell the car at a scrap value. So this part, this 35 is what is the depreciable value. This is the amount that will depreciate over the tenure of the asset. Then what is residual value? Oh, let's look at the expected useful life first. Expected useful life is the period used, not the asset economic life, right? Is the period that you intend to use the asset. The asset might have a more than, for example, let's say you want to depreciate your machine for 4 years. The life of the asset might actually be 10 years. Do you understand? This is just an accounting estimate that you have done. Oh, I want to do that for 4 years, but the asset may be 10 years, right? So the asset economic life could be what? Would be longer. That is what we mean we use expected useful life for. Then what is residual value, which is what I explained here. Residual value is the estimated disposal cost at the end of what? The useful life. When I was using this example, I said, let's estimated is what? 500,000, right? Now let's look at depreciation method. Depreciation method, an entity is permitted to a choice of depreciation method. You can either use the straight line method or the reducing balance method. The depreciation shall be reviewed annually and shall be changed to reflect the change in the expected pattern of consumption in future. The change shall be accounted as change in accounting entries. Change in accounting entries. I want to see if I can quickly make some examples around depreciation, the difference between straight line depreciation method and what do you call it? And reducing balance method. I have some examples towards the end. You can see these are some of the examples we are supposed to look at, or maybe we can be taking them in the course of the class. So let's just look at this so that we can use that to explain, able to track where we are at every point. Okay, so let's look at this. Since we are on, this is where we stopped, measurement after recognition, and we're looking at straight line method or reducing balance method. We'll look at this revaluation method. So under the cost model, that's what we're still looking at. We'll look at revaluation method afterwards. But let's look at a quick example. Can you see my screen, please? Can you see my Excel?
Yes, sir.
Okay, thank you. So I may need to take this off PowerPoint. Oh, okay, let me see if I can see the question of. Oh gosh, how do I do this? Okay, so let's just take the question and I'll write the details down. Okay, so an item of property, plant, and equipment. You can still see my Excel, right?
Yes, I can see.
Okay, thank you. Once I put in the details, I'll put it on full screen. An item of property, plant, and equipment costs 750 million. So initial cost is what? Initial cost is what? 750 million. 750, 123, 123. Let me add some commas to make it more interesting. Okay. It's expected to have a useful life of what? 5 years. Useful life. If I were you in the exam, I'll be writing it just like this out so that I can able to focus on where the points are. 5 years. What is the next thing? Using straight line method of depreciation, what is the annual depreciation charge and what will be the carrying amount of the asset after 4 years? Oh no, we missed something, you see. It's able to have 750 million to have a useful life of 4 years and an expected residual value of what? 5 million. So write residual value of what? 5 million. 5, 1, 2, 3, 1, 2, 3. 5 million. Let's add some commas to make it good looking. So our first question is what? Annual depreciation charge. Our second question is what? Carrying amount after 4 years. Okay, so let's use our Excel now. Let me bring it up a bit. So what I did so far was just to write out the information. You confirmed that you could see my screen, so let's just continue. Okay, so this is the information that we have, right? Depreciation charge. Depreciation charge. You remember when we were talking about the other time? Depreciation charge. How do you calculate it? This is the first question. Depreciation charge is calculated as initial cost less what? Can you think about it? Initial cost less what? You remember when I was talking about the depreciable value, what did I remove? I want to carry you along in this class. Are you there, Motu?
Yes, sir.
Okay. Please stay with me. It will be initial cost minus residual value. Minus residual value. So this is the same thing as what? The depreciable what? Value. The depreciable value. Let me just show you when we spoke about it. When we spoke about it here. We said our depreciable value is what? See it here. Our depreciable value is what? The cost of the asset less its residual value. And I made an example here. I said if the cost of the asset was 4 million naira and we said the residual value is what? Is 500,000. 3,500 is the residual, is what? Is the depreciable value. This is the value that would divide the number of years with. So let's go back to our Excel. So this is okay. So you will now divide this one by the useful life of the asset. Divide it by the useful life of the asset. So divide by what? Useful life. So you can see that this is actually very interesting and easy to solve. Very interesting and what? Easy to solve. Very interesting and easy to solve. So if we look at this now, what's our calculation? It will be what? Give it to me. 750,000. 750,000 minus what? 5,000. That one will give us 745,000. Divided by what? 5 years. Divided by 5 years. Divided by 5 years. And this one will give us what? Can you press your calculator and tell me the answer?
149,000.
149,000. So this is going to be what? Our annual depreciation charge. IAS is actually very simple and straightforward. Once you understand the measurement, right? Measurements at initial measurement, initial cost, measurement after, you understand the depreciation, you understand the asset schedule, how to do the asset schedule, and you recognize how to take care of the asset when you sell it off. Just take it from, when I buy the asset, what do I recognize? This is what I recognize. If I buy a new asset, what do I? As I'm using the asset, how am I recognizing the value of the asset? It's simple and easy to follow. So this is what the depreciation charge. And using the straight line method, the depreciation charge would be equal. So let's do something. How many years are we supposed to use the asset? 5 years. If you want to check if your answer is correct, just do 1,495,000, multiply it by the number of years, 5 years, Abi, and add the residual value at the end of the year. It's 745,000, right? Add 5 million to it. 5 million to it. When you add 5 million to it, it will be what? 5 million. 5, 1, 2, 3, 1, 2, 3. What? 750,000. Can you see? Is this not the same asset value that we have here? So what this means that what this annual depreciation charge means that, is annual. It means that every year we'll be removing 149 million from the value of this asset. So let's quickly do something so that we can explain more. So, we said something about in year 1. The second question has us to do what? What is the carrying amount after what? After 4 years. So let's do it like this. Initial what? Initial cost. Initial cost is how much? 750,000 naira. 750,000 naira. Our annual depreciation charge is how much? Stay with me. 149,000. You remember when I was doing, and let me go back. You remember when I was on this stage, when I said initial cost, remember, minus accumulated depreciation will give us what? Our what? Net book value, or our what? Our carrying value. You remember carrying amount when I said that there. So the same thing applies here. So this year will be a negative sign because we are using it to reduce what? The value of our asset. So this is a short way, but this is not the way we do the final asset schedule. But let's just do it this way. So year 1, balance at end of year 1. Can you do that in your calculator and tell me the value? 750 minus 149. What do you say?
601. 601 million.
601 million. 601 million. Sorry. 601 million. So this is the balance at the end of year 1. This means the same thing as what? Balance at the beginning of year 2. Do you agree with me?
Yes.
Balance at the end of year 1 is the same thing as balance at the beginning of year 2. So balance at the end of year 1, let's just divide. In year 2, we apply another word, annual depreciation charge. How much do we charge again?
149.
149,000. How much will be the balance at the end of year 2? How much will be our assets balance, the carrying amount at the end of year 2? Please tell me. What is it?
452.
452. The same thing. So we just repeat this for year 3 and year 4, and we'll get our final answer. So year 3, we'll have what? Our depreciation charge remains 149, right?
Yes.
Our balance at the end of year 3 will be how much? Give me the answer. What's your answer? 303. Our annual depreciation charge for the year 4 will be what? Same 149, right? Our balance at the end of the period will be how much?
154.
154. So what is our question? You can see they said what? Calculate what? The carrying amount after year 4. At the end of year 4, we'll have what? 154,000, right? Which is the same thing as what? Balance at the beginning of what? Year 5. They can ask you the question and say, what will be the carrying amount at the beginning of year 5? You should know that means the same thing as what? Balance at the end of year 4. Let's look at another question. So that we can finish depreciation and move on to some other things. So let's look at the second question. Okay. So let's bring this down so that we can write the informations. So now, a non-current asset costs 100 million. It is depreciated using a reducing balance method at the rate of what? 20% each year. What is the annual depreciation charged in years 1 to 4? What is the annual depreciation charged from years 1 to 4? Let's just write the information out like we did the other time. A non-current asset costs what? Initial cost.
100 million.
Once you do it this way, you'll be able to factor many things that may go wrong. Once you write out your details, this is what I advise, especially if you are doing if it is OBJ, you can quickly use your calculator to quickly do it. You get move on straight away. But what is the rate? It is using balance, reducing balance method at the rate of what? 20%. So we do what? Rate 20%. 20%. What is the annual depreciation charge in years what? 1 to 4. Annual charge for year 1 to 4. That is the question. So we can go back to our full screen to solve this. I'll show you the difference between reducing balance method and straight line method. Reducing balance, straight line method is initial cost minus useful life, right?
Yes.
Minus residual value divided by the useful life. In some instances, the residual value can be 0. So in this case now, they gave us residual value as 5 million. In some instances, the residual value might be 0. You still do what? Initial cost. When it's anything minus 0 is that number, right? 5 minus 0, 750 minus 0 is 750. 750 divided by what? The useful life. That is this. And you can see the depreciation charge is the same across all the periods. Depreciation charge, you can see, is 149 that we used throughout. But when we do for reducing balance method, you will see that it will not be the same. It will not be the same. So let's quickly do this so that we can use that to explain depreciation charge. They are simple. I told you, they are simple. So let's do initial cost plus the depreciation charge for the year. So the initial cost is what?
100 million.
So for reducing balance method, it's simple. You just have to be careful. It's very simple. What you do is what? Cost times your rate. That's all. Annual depreciation charge is equal to what? Your net book value. Let me use our proper English. Net book value times your what? Your rate. Your depreciation rate. Should I put that one too? Depreciation rate. The reason I use net book value is that so that you are getting familiar with all these terminologies. I would have just used cost, but it's better you start getting to used to all these terminologies so that you can be speaking like a proper accountant. So look at what we did here. We said the is what? Net book value times what? Depreciation rate. I hope you are noting this down in your notes.
Yes, sir.
Motun, your hands are raised.
Sir?
Should I lower your hand? Do you have a question? I see your hand raised.
No, that's the
Okay,
one that
don't worry.
raised up my hand. So then I want to tell you about the screen not showing.
Okay. Thank you. Okay, so what will be our depreciation charge for the first year?
Initial value time, that is 100 million times 20%.
Please tell me what's the answer. What will you get as your answer? 100 million times what?
100 million times 20%.
100 million. So I don't miscount this thing. Let me just use this one. 100 million times 20% times 20%. And that will give us what? 20 million. It will be a negative value, so let's put negative in front. What will be our balance at the end of year 1?
20 million.
What do you say?
Okay, 20 million minus
I can't hear you.
20 million minus 100 million. 80 million.
80 million. Thank you. So this is our what? This is what we call our net book value, or our carrying amount at the end of year 1. Am I making sense? Should I continue?
Yes, sir.
Okay. So our depreciation charge for year 2, you now will be what? This net book value times what? Our what? Depreciation rate. Can you calculate it for me and tell me what you have? It will be 80 million times 20%. I want you to use your calculator. What did you get?
60 million.
How much?
60 million.
16 million. Thank you. 16 million. So this is what? Our depreciation charge for the year. Our depreciation charge for the year. Are you with me? See, in year
Yes,
1,
sir.
our depreciation charge in year 1 is what? 20 million. Our depreciation charge for year 2 is what? 16 million. Do you understand why they call this now reducing balance method?
Yes, sir.
As the balance is reducing, your depreciation expense or depreciation charge is also reducing. So what will be our balance for at the end of year 2? Please
80
tell me the
million.
answer. I'm waiting.
80 million minus 60 million. 64 million.
64 million. Please tell me the
Yes.
annual depreciation charge for year 3. Just tell me. What should I do? Just be telling me.
64 million. 64 million minus.
I'm talking of annual depreciation charge. How do we calculate annual
Okay.
depreciation charge?
20% times 64 million.
Sorry?
20% times 64 million.
Okay, what did you get?
Okay. 164.
Is this what you have?
Yes.
Okay. So you can see the process is the same. This minus this, you get this. This is our balance at the end of year 3. You do your depreciation charge again. You do 20% times this amount. Once you get it, you subtract from your previous balance. So this will be our balance for what? Year 4. What was our question again? This question says, calculate what? Annual charge. So you will just do a table and say, annual charge for year 1, 20,000. Annual charge for year 2, 16,000. Annual charge for year 3, 12,800. Annual charge for year 4, 10,240. These charges are the ones that will go into your income statement as what? Depreciation expenses, right? But you will now ask yourself, we said something when I was discussing earlier, when I was discussing this place. I said something about initial cost minus what? Accumulated depreciation. Remember when I spoke about this? Give us our net book value. We are going to look at this in detail, but I only use this to explain what it is. If you sum all these depreciation charges together, let's just even do it itself. Let's sum up all these depreciation cost charges together. In the first year is how much? 20,000, right? In the second year, 16,000. Year, 12,800 and 10,000 for, hold on, 59,040. Can you see?
Yes.
If you add this and this together, it will give you 100,000. Do you understand? So it's just that we have a simple question and we have decided to just do it this way so that it can be faster. Do you understand? When we are doing the asset schedule, this is not the way we'll do it because we will have to report what the accumulated depreciation is at the end of each year. Do you understand? But this is a way to explain based on the current stage that we currently are. Now let's go. Let's see if we can take the last question. An office equipment which originally cost 75 million naira with accumulated depreciation of 51 million was sold for 18 million and the cost of disposal was 5 million. What is the gain or loss on the office equipment? What is the gain or loss on the office equipment? So let's look at this together. Do you have an idea on how this question will be solved? Do you have an idea?
No, sir.
Okay, so I just want you to tell me, okay, what I expect is that we'll do it this way, we'll do it this way. I want you to start thinking about how to solve questions. You understand? That was just what I was expecting, not that you will solve it. Or you were thinking I would say, okay, now that you know it, yeah, go ahead and solve it. No, don't worry. So let's bring out the information as we usually do. Please tell me you can still see my Excel and screen. An office equipment which originally cost 75 million. Original cost is how much? 75. As an accumulated, I explained what accumulated depreciation is the other time. All the total depreciation that we have done on the asset till date, right? 51 million. It was sold, selling price, sold at, let me just write, sold at 18 million. And the cost of disposal. You know what they call cost of disposal? Huh? Anything you don't know, always ask me, oh, bro. What's cost of disposal? I will explain. So cost of disposal is, when you were trying to sell the asset, all the additional expenses that you incurred in selling the asset. Do you understand? So, in Nigeria, we usually have people that do agency fees. Maybe you have to write, you have to do some legal documents. Do you understand? All those things goes into your cost of disposal. Do you understand?
Yes, sir.
Okay. So then the question is, what is the gain or loss on disposal of the office equipment? Have we even gotten here? But let me use this opportunity to explain this one so that we just get there and we move on. So this is the information that we have. Looking at this and all the explanations I've made earlier, what is the net book value of this asset? What is the carrying amount of this asset? Please tell me. How do we calculate net book value or carrying amount?
$75 million.
How do we calculate it? Tell me, I'm listening. You said something the other time now. Confidently say it again.
The 75 million minus 51 million.
75 million minus 51 million. How did you get that? What was the thought process? 75 million is what?
Is our carrying cost.
Is our initial cost, exactly. So now, first thing to do is to what? Calculate net book value. Net book value. And our net book value is what? Initial cost minus accumulated depreciation. I've showed this over and over again. Initial cost minus accumulated depreciation, which will be what? 75 million minus what? 51 million. Thank you so much. And how much are we going to get for this? It means what? What does this mean?
24 million.
It means, yes, 24 million. It means that in our book, the asset is worth how much? 24 million. This is the value of that asset on our what? On our book. Are you with me? Should I continue?
Yes, sir.
It's just like, that when I was asking that, how will you treat this? I was expecting you to like say, this is the way I would treat it, even if you don't even have the accounting process. Do you understand? Because you can get something like these questions in your exams. They are simple and easy questions that even without you writing all these things, and especially if it is OBJ part that you saw it or fill in the gap session, you just quickly attack it and move on. This asset is worth 24 million. How much did we now sell it? How much did we sell it?
We sold it at 18 million.
We sold at 18 million. And we incurred how much as cost? Cost of selling it is what?
5 million.
Are we not going to remove the 5 million from it?
You remove it.
We are going to remove it. So that means that our final selling price, cash that came to us is what? Net proceeds from selling price will be what? 18 million, right? Minus 5 million. How much did we get? 13 million. If our asset is worth 24 million, let me bring this to the side here. So I can, okay. If our asset is worth 24 million and we collected 13 million as income that came to us, did we make gain or did we make a loss?
A loss.
Loss. So loss on disposal will be what? How much?
24 million minus 13 million.
13 million minus what?
24 million.
Minus 24 million. How much is that?
11 million.
11 million. So loss on what? Loss on disposal is 11 million. And this also goes what? Goes into our income statement. We will reduce our profit by 11 million based on the loss that we incurred on disposal of that asset. So let's go back to our slides. We've done the practice questions. I think I have some other questions here as assignment. So see, I have one more practice question we're going to do. Then you take this as assignment. So we're almost there. Almost there. Let me see our time. Oh, our time is fast spent, so hopefully we can complete that one. Okay, so earlier on we were talking about measurements after recognition, and we have done the cost model. We have said that what cost model is cost less accumulated depreciation and if there is any impairment loss. We have used all these parameters here. We have done the straight line method. We have done the reducing balance method. We even did gain or loss on disposal of assets. Now let's look at the other option. How do we measure assets afterward the initial recognition? And that one is what we call the revaluation model. An item of property, plant, and equipment whose fair value can be measured reliably may be what? May be carried at a revalued amount. Now, let me explain what revaluation model means so that you can now start using your head a bit to process it. So I have an asset. I bought this my office building 25 years ago when Naira was still very good. I said I was going to use it for 30 years that time. 30 years, that was what I said I was going to use it for. I've used 25 out of the 30. I bought it then, let's say, at 10 million Naira. Right?
Yes.
Now, that building, I have only 5 years to use on that building. Based on what? Based on, I said I was going to use it for what? 30 years before. And I bought it 25 years ago at 10 million Naira. I may revalue it based on the expected useful life of the asset. So I can say, this asset can still take me, instead of 5 years time, I can revalue it and say it will take me for 10 years, right? If I change the dates that I want to value the asset using the cost model, in as much I'm not touching the amount, I'll use the cost model to get the new depreciation amount. But in this revaluation model, it speaks to the fair value of that asset in the market. So that building, I bought it 25 years ago. It was worth what? 10 million Naira. But in the market today, if I want to sell that building is worth 500 million Naira. But in my book, anybody that sees my book will see me carrying land, office, and equipment, PPE of what? Maybe I bought it 10 million. Maybe the net book value now is about maybe 1,000 Naira safe, right? Or let's just say 50,000 Naira. Maybe that's the net book value. But meanwhile, the asset is worth more, far more than that. Do you understand? So this is what speaks to the valuation model. An item of PPE can be measured reliably, may be carried at what? At a revalued amount. So you go to the market and say, what is the fresh value that I can measure this, that I can get this asset for? If I decide to sell today, how much will it be? How much is this my office building? How much is this my asset? What now in the market? Now, the revaluation amount would then be what? Subject to depreciation and impairment losses for the what? For the remaining useful life of the asset, which will now represent the fair value of the asset. So let me bring out my Excel. This asset, let me use one of the examples that we used before. So this asset that we bought here, after year 4, we said what? The value of the asset. Okay, let me use the one that was straight line depreciation. So balance at the end of the year is what? 154,000. Let's just carry it. Let's say it was for. Are you with me? Should I continue?
Yes, sir.
154 million. This is the value at the end of the year. We are supposed to use the asset for 1 more year, right? But we now looked at it. During this question, when we're solving this question, the tenor was what? 5 years. You remember, right? 5 years.
Yes.
We have only 1 more year to use the asset. If you apply 149,000 to this question, it will remain our disposable residual value of what? 5 million naira. If we remove 149 from this, it's only 5 million that will be left. We now, at the beginning of the 5th year, we now looked at it. How much is this our asset in the market, right? How long can we still use this asset for? After looking at everything, we now said, this our asset is valued at its fair value. Fair value in the market is what? Fair value in the market is what? Let's say it is now 500,000. It's also possible that even at this 500,000, that it is still 1 year that asset can stay, right? But I'm also saying that it's also possible that we now looked at it again and said, this asset, it still has 4 more years to go. Meaning that it can take us for what? That means the total useful life of the asset will now be what? 8 years. We have done 4 years before. We have another 4 years. We can now say, the asset has years remaining for the asset. It was 1 year before. We now said it has 4 more years to go. Our new annual depreciation figure would be this 500,000 divided by what? By 4. That would be our new what? Annual depreciation charge. You remember our formula, right? Of annual depreciation charge for straight line method.
Yes. So we are not going
Value?
to have anything. Yes. Yes, sir. I said, so are we not going to have anything to do with the balance at the end of year 4 again?
So we will not use this again. This is now what?
Okay.
The revalued amount. We have revalued the asset, so we will carry this revalued amount, right? If it is 1 year that is remaining before that I want to maintain, we'll just maintain it. But it's not, if we have only 1 year remaining, just discount this one for the remaining of the year now. Do you understand? But usually you see that the years remaining too will change, right? So when the years remaining also has changed, we will need to calculate what? A new annual depreciation charge. From the point of where we revalued it and we change the years remaining, we'll now calculate what? Another annual depreciation charge. In this previous question, maybe we have said residual value is going to be what? 5 million. In this other one, we might say that after the 4 years now, there is not going to be any residual value. We just do our annual depreciation charge as what? 500,000 divided by 4. And our annual depreciation charge will be 125. So in year 5 now, we will apply 125. In year 6, we will apply 125. In year 7, we'll apply 125. In year 8, we'll apply 125. And we'll finish with this 500. Do you understand now?
Yes. This year 4.
Yes.
You said for the initial balance, the former balance, before we revalue the asset.
So your mic is not that loud, and so I'm always straining my ears to hear you.
All right. I'm trying to say that when we calculated it first, our balance at end of year 4 is 154,000.
Yes.
So when we now revalue it again, The amount was 500,000 now in the market, so we valued it 500,000.
Yes, you are
Then
correct. Yes.
this new 4 years that we used again is another new 4 years, or
Is the
the
no,
previous four
before we
years?
said the asset was going to be used for what? 5 years.
Okay, 5 years.
We have done 4 years here. We have depreciated 4 years. Right? This is the balance at the end of year 4.
Yes,
But at the end
yes,
of that year 4, we are now saying that this asset, this building or this machinery can still serve us with the way we used it before. We can still use it for what? Another 4 years.
okay,
This is an example. Oh, it can be 3 years. I can change it to 3 years. Do you understand now?
yes, sir.
At the point that you are revaluing the asset, you are saying that how long can I use the asset for from today to the future? In some instances,
Okay,
they will tell you that the asset will have a total cumulative period of what? I can do that again. I can, this one I wrote years remaining. I can say that
yes,
total years of the asset, total useful life. Do you understand? Useful
yes,
life of the asset will now be what? It was 5 years before, it will now be 9 years. If it's going to be 9 years, I've used 4 years before. So I will be dividing my revalued amount with what? I've used 4 years before. I have total of 9 years. How many years is remaining?
5 years.
5 years. I'll be dividing my revalued amount by 5 years. So this 100,000 will now be my what? Annual depreciation charge. I've used like 3 examples to explain now. They can tell you that total useful life of the asset will now be 9 years. They can tell you that total remaining useful life of the asset, or they can tell you remaining years of the asset is 4 years. All you are interested in is the final, how many years do I have from the date that I'm revaluing to what? To the expiration of the asset. Do you understand now?
Yes,
Okay, thank you. So when an asset is revalued, the entire class of PPU to which that asset belongs must be revalued. The increase in the carrying amount of PPE is credited toward comprehensive income statement and transferred to changes in equity under revaluation surplus. So that's how you treat it. The increase, you might say, how do I now take care of the increase in the value? How do I take care of the increase in the value? You credit income statement and you also take it to what? Your statement of changes in equity as your what? Revaluation surplus. So if the increase in carrying amount reverses a previous decrease, then increase in carrying amount is recognized in income statement to the extent it offsets the previous decrease. So let's look at how do we the recognition of property, plant, and equipment. When an asset is sold off or disposed, how do we take care of this? When an asset is disposed or it cannot provide any more future economic benefit, it is what? It is derecognized. When we looked at this disposal of assets, this question the other time, when you look at this asset, the disposal, you can see when we dispose this asset off, this cost that it has accumulated, we are going to remove it, right? Because we have taken it off our books. Profit or loss on the disposal of the PPE in the statement of profits and loss, but it's treated as what? As income or loss. When I said it the other time, when we looked at that question, I said that loss on disposal, you take it to the income statement and you add it, you reduce it from your profit for that year. If you made an income, you take it there too and you write it as what? Gain on disposal, and you will add it to your income for that particular year. When an item of property, plant, and equipment are held for sale, the carrying amount is transferred to inventory. So the proceeds from the sale of such property, plant, and equipment should be recognized as revenue. So this one, so let me give an example with this. Somebody that is selling house, would they recognize the house that they are selling under PPE, or will they recognize the house that they are selling under inventory?
They will recognize it under inventory. It will be
They will
recognized
recognize it
under
under
inventory.
what? Under inventory. Yes, because that's what they are holding it for sale. They are not using it for the daily operations of their businesses. Somebody that is selling car like Elizade Motors, all the cars that they have in their shop will be carried as what? As inventory, not as PPE. For somebody that is not selling car, maybe he's selling clothes, but has a car that is using to what? To sell clothes, that will be recognized as property, plant, and equipment. And when an asset is disposed, you do what? It is derecognized from the asset schedule, meaning that you remove everything that relates to that asset from the initial cost, you remove it from there. The accumulated depreciation that you have provisioned for that particular asset at that particular time, you remove it from there. Then you recognize either the profit or the gain on sale or the loss on sale from the income statement. Let's look at the disclosure requirements of IAS 16. IAS 16 requires the following disclosures in the note to the financial statement for each of the property, plant, and equipment. One, the measurement basis. Are you using cost or you are using revaluation? So everything that we've been discussing since is required to be stated. Depreciation method. Are you using straight line method or are you using reducing balance method to state it? Useful lives of or depreciation rate. Are you using what's the useful life of the asset that you have been using? You state it. Are you using depreciation rate? You state it. If it's depreciation rate, it has to be consistent and uniform throughout. Gross. Hold on, please. Gross carrying amounts and accumulated depreciation at the beginning and end of the period. Assets classified as held for sale. State it that these ones are assets that you are planning to dispose of and you are holding for sale. Then you also add the new asset that you got during the year. Increase or decrease arising from revaluation and from impaired losses and reversal thereof. Asset pledged as securities for liability. You can see almost anything that you can think of regarding that asset, you should do what? Disclose it. So if you are writing in the exam, you can think of anything. Number one, what's my basis for measurement? Just be writing it. Once you hear disclosure agreement in accounting, no hidden thing. Everything must be what? Must be disclosed in the notes to the financial statement. Even the assets that you have pledged as security for loan at the bank, you say, our head office building, it's still our own, you understand? But we pledge it to GT Bank, Access Bank, or it has been pledged for, you understand? You write it there. Asset in the course of construction. So you are constructing building. You remember when we said this part, that we said that the principle of measuring cost applies to both acquired asset and constructed assets. So when you are still constructing, all the costs that you have incurred, you understand, to that particular date, the value of those costs that you have invested in the business, in the assets, you would state them. You also state if you use an independent valuer, or not, or if you use it at cost. Methods and significant assumptions used in assessing the fair value. How did you get the fair value of whatever you have done to that particular stage, even if you want to sell it? So the another thing, a reconciliation between opening and closing values for gross carrying amount and accumulated depreciation, showing additions during the year, disposal, all these ones, I've mentioned it earlier. So this is what the statement of non-current asset looks like. This is what the statement of non-current asset looks like. Look at this and tell me if you have any question regarding any portion of this statement. Just look at it for now. So you have the initial cost. Do you buy additional asset during the year? You add it to it. Did you sell off any asset during the year? Disposal, you remove it from it. Then that would lead you to what is the total value at the end of the year. Do you understand? So this is the cost part. At the start of the year, I have 100 million for buildings. I bought 200 million worth of buildings this year too, right? This is the start of the year. This was my cost, total cost. I sold buildings worth with initial cost worth 40. I was valued at 40. This one will be removed. The total assets at the end of the year will be 1,200,000 minus 40. That will be 1,160,000. Right? Then you look at the accumulated depreciation. Total accumulated depreciation that I've incurred from all this while that I've been that I have been depreciating my assets. I've been depreciating my assets is 400,000. So at the start of the year, you write down one. How much did you charge for the year? You put down one. At the end of the year, what's your total depreciation? Do you understand now? So you will have this. Oh, sorry. Yeah, I'm supposed to have at the end of the year. Everything you are supposed to have at the end of the year. They're supposed to be at the end of the year. I'll correct this and send the corrected version at end of year. Can you see what I'm doing? So this one you're supposed to have at the end of year. So everything you can see, end of year. Then this one too, you're supposed to have end of year. Then what? End of year. I can't hear you again, Motun. Should I continue?
Yes, sir.
Okay. So once you do that, this is just the template. So you just do what was your total accumulated depreciation? What did you charge this year? You add it to what was there before. Give you a new total, which is what you total here. So this, let's say this one was 400, and this one was my new charge for the year is 80. Right? My total accumulated depreciation will now be what? 480. Do you understand? So it's as simple as that. It's just the same way we did that first one that we said what? Cost minus what? Accumulated depreciation equals what? Cost minus accumulated depreciation equals what?
Net book value.
Net book value or what? Carrying amount. So what was your net book value at the start of the year? You put that here. And what is your net book value at the end of the year? You put that here. The value at the end of the year will be your cost here and your accumulated depreciation here. That is what you get as your net book value for the end of the year. So let's look at another example where I hope that we are able to finish before the town hall that is different from Balabri. We have like 10 minutes to, don't mind me, I'm just joking though. Let's look at this question. Let me bring out my Excel, but let's read it first. So what is required of us? Prepare what? The non-current asset schedule for the year ended December 31, 2021. Now let's look at the information. The following information were contained in the non-current assets register of Abiodun Limited on December 2020. All figures are what? Are in millions. All figures are in millions. So this is the cost part. This is what? The accumulated depreciation part. And they said we should do what? Do the rest. Now look at this schedule I showed you earlier. Can you see the cost part? Can you see the accumulated depreciation part? Then you can see we have the different types of assets, buildings, machine, plans, then we total it to the side. That's exactly what we'll do first. So once you see an asset schedule, you should just be happy and say, okay, I know what to do. What do I do first? Based on my formula, I said cost minus what? Accumulated depreciation. I'm just showing you how I think in the exam. Cost minus accumulated depreciation equals what? Carrying value or net book value. So now we go to our cost. Costs at the start of the year. We add our additions and we remove what? Our disposal. Very easy. Cost. What is the cost at start of the year, right? We add our additions. Are you with me? Please be rolling with me. And we'll remove what?
Disposal.
Remove our disposal. For our accumulated depreciation, what do we do? For our accumulated depreciation, I don't want to show you my screen. I want to know if you know that now. For our accumulated depreciation, what do we do? At the start of the year, what we charged and what? Value at the end of the year. Value at start of the year. Depreciation what? Depreciation charge for the what? For the year. You know that depreciation charge that we were calculating since that we're saying under this one, when we're saying depreciation for year one, that is where it will come in. This place. Value, no, depreciation charge for the year. And what will be the final one?
The final one will be accumulated
Depreciation at the end of the year. At the end of the year. Then we'll have what? Carrying value at the beginning of the year and at the end of. Should I continue now?
Yes,
Should I continue? Are you with me? We have 7 minutes to get out of here. Okay. Carrying value. I wrote carry value. Carrying value. What's going on? I think I need to eat. This one that my eyes is seeing bala blue. Oh, thank you. So now let's go back to our question. Now that I have seen this, and I think we've tried to duplicate it there, is there anything that we missed out? No. So let's look at the question again. So the question says, costs at 31/12/2020. The following information were contained in the non-area of limited on December 31, 2020. Freehold buildings. So what do we do? All those assets, where do we put them? Let me just bring an Excel and let me drag it down. Permit me to bring it down like this. Can you see my screen? And the Excel?
Yes.
Can you still see the Excel?
Yes, sir.
Okay. So we're going to write the different assets up here. Freehold building. The next one is what? Motor
Motor
vehicle. Motor vehicle. The next one is what? Plant and equipment. And the next one is construction in progress. Then we write what? Our total. What do you say?
I thought it's only asset to write up there.
Yes, construction in progress is an asset.
Okay.
You know, when we were discussing, you remember now, I said it here. When we were discussing how to measure, can you remember? Can you see my screen? We said this for what? For both acquired and constructed assets. In as much as the assets will be completed and will bring it for use, is an asset that will do what? That will bring economic value to the business at the end. But it's just that you are not paying everything in full at once. You understand? You are building it. When it finishes, do you understand? You are going to use the asset. So construction in process is an asset to the organization. Just imagine that First Bank is building a branch beside your house. So you don't want them to add that branch to their balance sheet as asset. What would they carry it as? They have not finished it, but at least they bought the land. They built something on it and it's in construction. The value at the end of that day, end of the year, you put it on the asset. So it's part of it. So this is the table: freehold building, motor vehicle, plant and equipment, construction in progress. Then we have our total. What is the cost at the start of the year when they gave us all this information? It said is what? 680 for freehold. Then for this one is 96,500. This one is 122,800, 800. And this one is 209,600. Let's sum everything together. Are you with me? I don't want to lose you. If I'm losing you at any point in time, please call my attention.
I'm with you, sir.
Okay. So these are the information they gave us here. Then accumulated depreciation, we need to add this part so that we can move to the other part of the question. Let me move this Excel back to this side. Please call it out for me. Accumulated depreciation at the start of the year is what?
54,400.
38,600 and 55,260. Construction in progress does not have any accumulated depreciation yet. Now let's look at the question again. They said additional information was provided. During the year, the company acquired a warehouse of 50,000 on April 30, 2021. What's that going to go under? What is it going to go under? Please. I told you, don't let me lose you. Where will it go under?
It will go under freehold building.
Take that again.
Freehold building.
It will go under freehold building. Yes. After under freehold building, where will I put it? Is it under addition or disposal or what?
Is it under what, sir?
Is it going to be under, you said it's going to be under freehold building. I agree. I'm saying, will it be under additions or under disposal or under depreciation charge for the year or at the end of the year? Which one will it be?
It will be under addition.
Thank you. That's what I want to hear. Under addition. So I want to give this thing like a table format so that it can look appealing, right? Okay. So under addition, we are putting how much?
50,000.
50,000. Thank you. 50,000. We have solved the first part of the question. We have solved I said the first part, the A part of the question. So let's go to point number 2. Let's read point number 2. The sum of 25,000 was incurred on the construction in progress, and this resulted in the completion of a plant costing what? 94,000 put into use by the company on June 30, 2021. This is a tricky part, but I like that we're using this question. So please tell me, what was the first part? The sum of 25,000 was incurred. How do we treat that one?
Construction in progress.
Under construction in progress, is it going to be addition or disposal?
Addition.
Addition. Thank you. 25,000. Let's sum up all these things to the side here. Let me just drag it down. 25,000. Now, can you tell me how we are going to treat the second part? They said after we incurred an additional 25,000 naira, what happened?
It resulted in the completion of plant costing 94,000.
It resulted in the completion of what? 94,000 naira worth of what? 94,000 naira worth of what? Plant. 94,000 naira worth of plant. So let's go back to our Excel. Let me increase it. Now tell me what you think. Just tell me what comes to your head. I won't, I've been very good. I like when people just try to also think through it, because we might not cover everything in class, but if you get to an exam hall, how do you think you are going to do this yourself? Can you see the question? Should I take it again? Should I remove my Excel? How do you think we should treat this? We have spent additional 25,000. We have classified it as what? Amount incurred, as what? New additions. But there's now another part of it. It's enclosed in what? See what? Completion of a plant costing what? 94,000 put into use by the company during that year. How are we going to treat it?
I think
they started the town hall.
I think we will add that 94,000 to plant and equipment.
We will add it to plant and machinery, 94,000. What are we now going to do? Is that all?
This is not in the
Our construction in progress will reduce too now. Have you forgotten? We were constructing the team before. When we now finish the house, it's no longer under construction in progress, right? We will remove the value from what? From construction in progress. So you have another line here where you will just call it like maybe revaluation. Do you understand? You will move that 90, how much is it? 94,000. Under plant, you put it under plant, 94,000. Are you with me? Are you still with me?
I'm with you.
Okay.
Basically.
No, you told me this part now. You told me this 94,000. Yes. So I'm trying to say, so new additions for the year will move this 94,000. So let me show you my screen again. The sum of 25,000 naira was incurred on construction in progress, right? You were still building the house. You spent additional 25 million naira on the house. Are you getting it? But immediately you finish spending the 25 million, it will first of all go in as what? Into your construction in progress. By the time you finished it, they said it resulted in what? In completion of a plant that has taken you a total cost of 94,000. You will move this amount, this 94,000. You said it will go into what? Into plants. So our plant will have new addition of what? 94,000. Is that correct?
Yes, sir.
So our plant will have addition of what? 94,000. But our construction in progress will not be this much again because we have moved an item from construction in progress to what? To plant and equipment. So that is the reason why we will have a revaluation, or what it should be revaluation. No, is it revaluation? No. It's going to be something reclassification. Sorry, reclassification. So it's moving from this class to another class. You don't understand? Do you get my point?
Yes. That evaluation I used that.
Okay, sorry. I meant to write reclassification. No, everything is starting with 3.
Yes.
So we will reduce this one by how much? 94.
90.
Oh, I'm using bracket and the same. 94,000. Are we good? Should I continue?
Yes, sir.
So this and this is in and out. They are negating each other out. But it's just that we need to move it from construction under progress to what? To plant and machinery. That is just how to do that one. Let's continue with our question. A delivery van that was purchased at a cost of what? 32,000 naira was disposed of in March. The carrying amount on the van was 20,600. This question looks as if it's not complete. I'm trying to look at it. We disposed it off, but they didn't tell us the amount that we disposed of. It was valued at 32,000, right? It was valued at 32,000. Okay. Okay, the amount that we dispose it of is actually not important because this is what we are doing the asset schedule. If we are given the amount that was disposed of, the only thing it would have done for us is would have been able to calculate if it was gain or, do you understand, loss on the asset. Do you understand me? So we don't need that information to do our asset schedule. What we just need is what is the value of the asset in our schedule so that we can remove it. Do you understand? Are you with me?
Yes, ma'am.
Okay. So a delivery van which was purchased at the cost of 32,000. So under our motor vehicle, what was the initial cost? 32,000 naira. You know, this cost here are all initial costs. You remember, right?
Yes.
So because we have disposed it off, we have to remove it from our initial cost. So disposal under motor vehicle, we remove it here. Once we remove it here, also look at the question. They said it has a carrying amount of 20,000. Can you see this part? It has a carrying amount of 20,600. This is our formula to calculate carrying amounts. right? Carrying amount is what? Carrying amount is what? Tell me now. I want you to be saying it so that you remember. Cost minus what? Cost minus accumulated depreciation. So in this case, they said our carrying amount is what? 20,600. Our cost is what? 32,000. So our accumulated depreciation is what we are looking for. We don't have it. Accumulated depreciation. So to get accumulated depreciation, what will it be? What will our accumulated amortization depreciation be? It will be what? 32,000 minus 20,600. And what would that one give us? That would be 20,600. So that would be what? 11,400. So that means that during the year, we have what? We have actually taken 11,400. Do you understand? On accumulated depreciation on that asset that we disposed. On that asset that we disposed. So we have to add another line that we will call what? Accumulated depreciation on disposal. Accumulated depreciation on disposed assets. You can write it like that or on disposal. How much is it? How much did we calculate it as? 11,400. We will remove it from this one too. 11,400. Let's go back to our question. The next line, freehold buildings are to be depreciated over 50 years, while motor vehicle, need to write this down. Freehold is what? 50 years. Motor vehicle plans and equipment at the rate of 20%. Okay, so motor vehicle and plant and equipment at the rate of 20% and 50% on cost per annum, respectively. Motor vehicle is 20%. And which one? Plants and machinery. Plant and machinery is to be depreciated how much? 15%. Have I done anything that you don't know how to do here?
No, sir.
No. Okay, thank you. So this is the information we have. Full depreciation is to be granted in the year of acquisition with no depreciation in the year of disposal. This is another thing that is common with what we usually get. They said full depreciation, you will charge full depreciation on the year that you acquire any property. But in the year that you dispose of that property, you will only charge what? You will only charge not charge depreciation in the year that you dispose of. So even if you sell the property at the end of the year, you will not charge depreciation on it. So we're almost done. Let's just quickly round up this. We have done depreciation a lot earlier today. So it's just to just touch base with what we have learned earlier. So this, let's sum this page up. We didn't write at the end of year from the beginning, at the end of year. So, sum it up. 680 plus 50,000. You sum everything up. Everything. To sum it up. What I did was just to sum this. Can you see? 209 plus 25,000 minus 94,000 will give you 104.60. 122 plus 94,000 will give you what? 216,800. If you see that this construction in progress, can you see that it has reduced? It was 209. Then we did some, we spent only 25,000. Then we removed something. We moved it to what? Completed plant and machinery. Then this one was 96,000 before. We sold a particular motor vehicle that cost us 32,000. You can see that it increased. It reduced rather. This one was 680 before. We bought an asset worth 50,000. It increased to 730. So this is what we have as at what? As at the end of the year for our total asset. Our value for depreciation will do the same thing. We sum up everything down. We have not calculated depreciation charge, but once we do, it will sum there. But let's just sum every other thing down. You can see this and this. This one, which is under what? Under motor vehicle. Remember that one that we removed, accumulated depreciation. We can't be keeping the accumulated depreciation when we have disposed of the vehicle. So we remove that one from it and we continue with the remaining assets. So it's this asset value that has this accumulated depreciation. We have not put in the depreciation charge for the year. I'm only using this one to explain, but let me bold this part because we're going to use them later. So now let's calculate the depreciation charge for freehold vehicle. They said freehold vehicle, freehold buildings. Freehold buildings are to be depreciated over what? 50 years. Over 50 years. And what other information did they give us? Oh, sorry. They also said over 50 years. While motor vehicles, plant and equipment at the rate of what? 20% and 15% on the cost. So let's just take this one by one and we continue with our example. So what is freehold building? What's the total cost? They have 730. But this is the cost at the start of the year. They also gave us a condition that you will do what? Full depreciation is to be granted in the year of acquisition, meaning that asset that we just bought, we are going to do what? We are going to do full year depreciation on that particular asset. So in the first instance, our full year, this is the asset that we're going to use. We're going to use this 730. Assuming they told us that full year depreciation will not be taken on the first full year, then we'll take full year depreciation in the year of disposal, and that will be different. So this one, we are going to take full year depreciation. So meaning that we'll add it to this one, and we'll get what our depreciation expense will be for a period of 50 years. So our cost is what? Depreciation charge for what? For freehold buildings. For freehold building will be what? 730 divided by 50 years. And that will be 14,600. So we'll move this 14,600 into our depreciation charge year. Oh, I'm trying to put minus 14,600. Am I making sense? Are you there? Or have you gone? Are you there? Okay. So we do this for depreciation for freehold building. We also do our depreciation charge for motor vehicle. And motor vehicle is to be charged on 20% on cost. See it here. Motor vehicle and plant are to be charged at what? A rate of 20% on cost per annum, respectively. So we go back to our Excel. To be charged on cost 64,500. So we do 20%, 20% times what's the cost? 64,500. 64,500. 64,500. As you can see, add our equal to 12,900. So move that to our depreciation charge here, 12,900. The same thing applies for what? Plant and machinery. Plant and machinery. That one is 15%. 15% times is also on cost. Also on cost. 21,800. And that will give us 32,520. Add that in our depreciation for the year, 32,520. Once that is done, you can see our table has fully summed itself up. We have our charge for the year, we have our accumulated depreciation, we have our charge for the year, and everything is summed up. So what we just need to do now is get our carrying amount for the beginning of the year and at the end of the year. So to get our carrying amount at the beginning of the year is simple. All the values from the beginning of the year, value at the beginning of the year, can you see? I picked cost minus what? Accumulated depreciation value at the beginning of the year. I get my value at the beginning of the year. I replicate that for everything here. Value at the end of my carrying amount at the value at the end of the year will be what? My my cost at the end of the year minus my cost at the end of the year, and I will get my carrying value at the end of the year. So this is the value that goes into my income statement as my net book value, So I made it bold. This is the beginning of the year. What you just do is pick the values at the beginning of the year minus the value at the beginning of the year. You get this. The value at the end of the year, pick the value at the end of the year, value at the end of the year, you will get the other one. So this is the end of our class today. I have an assignment for you on this page. Please attempt it. It's a standard question, 2 questions. Attempt it, and I will see you at the next class. Thank you once again. Thank you for everybody that joined the class. Thank you, Moturayo. Thank you for staying till the end of the class. So this is the end, and I'll see you in the next class. Any question?
No, sir.
What is it?
I said no, sir.
Okay, thank you. Please, you can go over the video one more time if you have any area of concern. So this is the assignment 1 and 2. Attempt it, and as usual, I know you will attempt. Please submit your assignment. Thank you very much. I'll see you next class. Bye-bye.